Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Fluence Energy, Inc. quarterly report. Fluence Energy, Inc. offers a diverse range of businesses and services to cater to the growing demand for energy storage and optimization solutions worldwide. The company's primary offerings include energy storage products that integrate hardware, software, and digital intelligence. These products are designed to meet various customer needs, such as large-scale front-of-the-meter applications with its GridStack Pro and GridStack systems. Additionally, Fluence Energy provides specialized products like UltraStack for critical system requirements in distribution and transmission networks. The company also offers a split architecture design, SmartStack, which incorporates embedded intelligence and higher energy density compared to traditional AC systems. In addition to its product offerings, Fluence Energy provides operational and maintenance services to ensure the smooth functioning of its energy storage solutions. Furthermore, the company offers digital applications that enable customers to optimize their energy usage and management. The company's customer base is diverse, including independent power producers, developers, conglomerates, utilities/load-serving entities, and commercial and industrial clients across various regions such as the Americas, Asia-Pacific, Europe, the Middle East, and Africa. The stock price of Fluence Energy, Inc., FLNC, has experienced a significant increase of over 66.67% in the past year, with its stock delivering a 130.08% change in the period leading up to January 2026. Several key news events and positive developments have contributed to this substantial growth. One major factor was the announcement of a large energy storage project in Arizona, which coincided with a significant gain in Fluence's stock. Additionally, the company's involvement in a massive battery storage project in Germany led to an increase in share price. The strong revenue guidance for FY 2026, which projected a 50% growth and secured approximately 85% of this forecast in its backlog, also spurred significant stock movement. The recognition of Fluence as a top-tier global battery energy storage system provider by S&P Global Commodity Insights further bolstered investor confidence, resulting in an increase in the stock price. Analyst upgrades from Goldman Sachs and Jefferies, which raised their target prices for Fluence Energy, also contributed to the stock's growth. The company's CONE 2026 results, although missing some revenue estimates, showed a substantial year-over-year increase in sales. The reaffirmation of fiscal year 2026 guidance by the CEO emphasized accelerating demand from various sectors, driving global energy storage needs, and expanding their pipeline to $30 billion since September 2025. These events have collectively fueled Fluence Energy's substantial stock price appreciation over the past year, driven by strong revenue growth projections, significant project wins, and positive analyst sentiment. Fluence Energy, Inc. market capitalization of $4 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Fluence Energy, Inc. holds a significant advantage in their industry. Fluence Energy, Inc. trades at a higher price-to-book ratio of 6.43 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 77% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be summarized into several key areas. Revenue growth is primarily driven by an increase in unbilled receivables and a significant revenue growth rate of 143% from 2024 to 2025. The company's energy storage products and solutions segment saw substantial growth, with revenues increasing by 165%. Additionally, services revenue grew by 44%, while digital applications and solutions revenue increased by 36%. The sale of energy storage products and solutions, operational services, and digital applications and solutions sales were also key drivers of revenue growth. Furthermore, changes in contract scope and milestones, liquidated damages from customers, change orders with customers to recover additional costs, and an increase in internal use software development costs contributed to the company's revenue growth. On the other hand, revenue decline was driven by a decrease in trade receivables and cash equivalents. The loss of contracts that exceeded total revenue also contributed to the decline. Furthermore, a decline in consulting services revenue was another factor that impacted the company's revenue negatively. The net income of the company experienced a decline between fiscal years 2024 and 2025, with a decrease of $5,575 or 10% from a net loss of $57,013 in 2024 to a net loss of $62,588 in 2025. This indicates that the financial performance of the company worsened over this period. The profit margins also saw a significant decline during the same period. The gross profit margin decreased by 6.5 percentage points from 11.4% in 2024 to 4.9% in 2025, while the adjusted gross profit margin dropped by 6.9 percentage points from 12.5% in 2024 to 5.6% in 2025. This substantial decline in profit margins suggests that the company's ability to generate revenue and control costs has been compromised. The reasons behind these changes are not explicitly stated, but it can be inferred that the company faced significant challenges during fiscal year 2025, leading to a deterioration in its financial performance. The analysis of the company's financial data reveals a concerning trend. Despite multiple conflicting statements, three clear indicators point to a consistent outcome. The company is generating negative operating cash flow. The figures on pages 9, 42, and 46 all show a net cash used in operating activities, with a significant amount of -$226,792 in 2025. This suggests that the company's expenses are exceeding its revenues, resulting in a substantial outflow of cash from operations. The company's financial health has undergone significant changes over the past year. A closer look at the data reveals a notable decrease in the company's debt level. According to the provided information, total debt decreased from $1,808,152 to $1,781,428, indicating a reduction of approximately $26,724. Additionally, the total debt level, including cash and restricted cash, saw a decline of $237,856 between September 30, 2025, and December 31, 2025. However, despite this decrease in debt, the company's interest expenses have increased substantially. The data shows that interest expense, income, net has risen from -$741,000 to $2.1 million, representing a significant increase of $2.8 million. Furthermore, interest expenses have also seen an increase of $2.1 million for the 3 months ended December 31, 2025. This trend is consistent with the data from 2024 and 2025, where interest expenses increased from -$741,000 to $1,372,000. These changes suggest that while the company's debt level has decreased, its interest expenses have risen significantly, indicating a potential shift in financial priorities or obligations. Management is optimistic about the company's outlook, citing continued business growth and innovation as key strategies. The company expects to differentiate its products and optimize its cost structure, positioning itself for long-term success. With significant remaining performance obligations totaling $5.5 billion over the next 12 months, management is confident in the company's ability to drive revenue. The company has also set a strategy to maintain total liquidity of at least $150 million by December 31, 2025, and $100 million thereafter. This demonstrates a commitment to financial stability and flexibility. Management acknowledges that growth comes with risks and challenges, but believes that the industry's unprecedented expansion presents significant opportunities for the company. In terms of specific goals, management expects gross profit margins to decrease as sales volumes increase due to economies of scale. However, this is seen as a necessary trade-off for achieving technology and product roadmap goals through increased R&D investments. The company also plans to expand its sales presence and marketing efforts into additional countries in the future. Overall, management's strategy involves investing in growth, which will lead to higher expenses, but is expected to drive long-term success and profitability. With a focus on innovation, cost optimization, and financial stability, the company is well-positioned for continued growth and expansion. The company has made significant acquisitions and divestitures in recent years. In terms of acquisitions, the company issued $400 million in convertible senior notes due 2030 in December 2024, providing a substantial influx of capital. Additionally, a new SCF facility was entered into with a third-party financial institution on August 8, 2025, further expanding the company's financial capabilities. On the other hand, the company has also made strategic divestitures to optimize its portfolio and focus on core operations. In June 2022, Siemens Industry, Inc. redeemed its entire holding of LLC interests, while AES Grid Stability redeemed a significant portion of its holdings in December 2023. These transactions demonstrate the company's commitment to streamlining its business and allocating resources more efficiently. The company's dividend payment history reveals a mixed record. While there have been instances where dividends were paid out in certain periods, the current financial situation has imposed restrictions on this practice. Specifically, the 2024 credit agreement has limited the company's ability to pay dividends as of now. Notably, there is no mention or indication of share buybacks being undertaken by the company. Concerns about inventory buildup and supply chain disruption exist. There are valid reasons to be concerned about the current state of inventory and supply chains. The data shows a significant increase in inventory levels from $455,015 to $540,638 between September 2025 and December 2025. This buildup is not just a minor fluctuation, but a substantial rise that warrants attention. Furthermore, there are potential disruptions on the horizon. Contracted backlogs may not translate into actual revenue as anticipated due to external market factors and economic conditions. Customers may experience project delays or cancellations, which can have a ripple effect throughout the supply chain. These concerns are compounded by the explicit acknowledgement of inventory buildup, with the company stating that it is indeed experiencing this issue. The combination of these factors raises serious questions about the resilience of the current supply chain and its ability to adapt to changing market conditions. It remains to be seen how these challenges will be addressed, but for now, they pose a significant threat to the smooth operation of the business. That concludes the financial summary for Fluence Energy, Inc. Feel free to comment below, and I will be happy to answer them when possible.